Hello, and welcome back to Tax and Financial Matters, the channel where we discuss various topics related to tax and financial matters. Today, we're going to explore Hallmark B, the second category of hallmarks under the European Union's mandatory disclosure regime, also known as DAC6. Are you ready to dive into these specific hallmarks? Let's get started. Before we begin, don't forget to like this video, subscribe to our channel, and turn on notifications to stay updated with the latest financial insights. Now, let's unravel the intricacies of Hallmark B in DAC6/MDR. A quick recap: what is DAC6? As a quick refresher, DAC6 is a directive implemented in the EU to promote tax transparency and fairness among member states. It requires intermediaries and taxpayers to report certain cross-border tax arrangements with specific characteristics, called hallmarks. These hallmarks are divided into 5 categories, labeled A through E. Hallmark B is the second category and consists of specific hallmarks linked to the main benefit test. Like Hallmark A, these hallmarks indicate that the main benefit or one of the main benefits of an arrangement is obtaining a tax advantage. Hallmark B, however, focuses on more specific types of transactions. Let's explore the 3 subcategories of Hallmark B, B1, B2, and B3. Why is it important to understand the different hallmarks, and especially Hallmark B? Understanding Hallmark B is crucial because it highlights the types of transactions that tax authorities in the EU consider potentially aggressive or abusive in terms of taxation. By identifying and reporting arrangements that meet any of these specific hallmarks, intermediaries and taxpayers can contribute to a more transparent and fair tax environment within the EU. It's important to note that arrangements that meet Hallmark B must also pass the main benefit test, as mentioned earlier. This means that if the primary purpose of an arrangement is not to obtain a tax advantage, it may not necessarily fall under the reporting requirements of DAC6, even if it exhibits one of the specific hallmarks in this category. Hallmark B1, acquiring a loss-making company. B1 targets arrangements that involve acquiring a loss-making company, with the main purpose being to reduce tax liability by offsetting the losses against the profits of the acquiring company. This hallmark raises concerns when the acquired company does not carry on any significant economic activity after the acquisition, suggesting that the transaction was primarily for tax advantage purposes. Hallmark B2, converting income into capital or other revenue. B2 covers arrangements where income is converted into capital, gifts, or other types of revenue that are taxed at a lower rate or exempt from tax. This hallmark aims to address situations where taxpayers engage in transactions designed to reclassify income to take advantage of lower tax rates or exemptions, ultimately reducing their overall tax liability. Hallmark B3, circular transactions generating tax-deductible interest. Finally, B3 deals with arrangements involving circular transactions. These transactions are designed in such a way that they ultimately result in the round-tripping of funds, generating tax-deductible interest payments. In these situations, the funds end up back with the original payer, but the interest payments are deducted for tax purposes, resulting in a tax advantage. Hallmark B examples. Hallmark B1. A profitable company, Company A, in Country X, an EU member state, acquires a loss-making company, Company B, with substantial tax losses carried forward. Company A merges with Company B, and as a result, Company A can use the tax losses of Company B to offset its taxable profits, reducing its overall tax liability. Hallmark B2. A software development company in Country A, an EU member state, earns significant revenue from its software sales. In order to reduce its tax liability, the company sets up a subsidiary in Country B, a non-EU jurisdiction with a lower tax rate on licensing income. The parent company then transfers its intellectual property, IP, rights to the software to the subsidiary. The subsidiary then licenses the IP rights back to the parent company, which continues to sell the software in Country A. By converting the software sales revenue into licensing income, the company benefits from the lower tax rate in Country B. Hallmark B3. A company in Country A, an EU member state, engages in a series of transactions involving multiple jurisdictions and entities to sell and repurchase a specific asset. The company sells the asset to a subsidiary in Country B, another EU member state. The subsidiary then sells the asset to a special purpose vehicle, SPV, in Country C, a non-EU jurisdiction. Finally, the SPV sells the asset back to the original company in Country A. This circular transaction is designed to generate tax benefits, such as deductions or tax credits, in multiple jurisdictions. The main purpose of the arrangement is to exploit differences in the tax treatment of the transactions between the countries involved. In this case, the circular transaction could be considered an aggressive tax arrangement that falls under Hallmark B3 of DAC6. Conclusion. In conclusion, Hallmark B plays a crucial role in the EU's DAC6/MDR by focusing on tax arrangements that take advantage of differences in tax treatment between jurisdictions. In conclusion, Hallmark B of the EU's DAC6 is a crucial component in identifying and addressing aggressive tax arrangements that exploit differences in tax treatment between jurisdictions. Through its three subcategories, Hallmark B targets a variety of tax planning strategies. Hallmark B1 focuses on the acquisition of loss-making companies, which may enable a taxpayer to offset the acquired tax losses against their own profits, reducing overall tax liability. Hallmark B2 targets arrangements that convert income into capital or other categories of revenue, such as interest, royalties, or dividends, subject to lower tax rates or more favorable tax treatment. Hallmark B3 addresses circular transactions, particularly those that generate tax-deductible interest through a series of interconnected transactions designed to exploit tax benefits in multiple jurisdictions. By understanding the implications of these hallmarks, intermediaries and taxpayers can better identify and report cross-border tax arrangements that may be considered aggressive or abusive. This contributes to the EU's goal of promoting transparency, fairness, and compliance in taxation, fostering a more equitable tax environment for all. If you found this video informative, please give it a thumbs up and subscribe to our channel for more content on tax and financial matters. Until next time, stay informed and take care.